details. But staying with the markets, HDFC Bank shares declined about 8%, marking the worst single-day fall in 3 years. Today's sell-off wiped out over 1 lakh crore rupees in market capitalization. In fact, HDFC Bank shares accounted for more than 50% of the fall in Nifty and the Nifty Bank. So why did the stock fall so much after its profit mildly beat market estimates? Latha Venkatesh is here with those details. Latha?
Well, yes, the profit beat, but it's the margins that the market was looking at. The margins came in at 3.4%, exactly as it did in the second quarter when the merger was actually, brought into fruition. Now, the whisper on the street was that the bank had apparently indicated that margins would improve. Second quarter, they were hit by the incremental cash reserve ratio, and the Q3 margins would be better, but it was not. And that disappointment took its toll. Now, what do we mean by margins? A 3.4% margin means that every time the bank gives a loan of 100 rupees, it makes 103.4 on every 100 rupee loan. But HDFC Bank, historically for the past 25 years, has had a margin of 4.2 to 4.3%, and that is how it is priced. The other fear in the street is that there is no spare cash left. You know, the bank had some extra government securities which it sold, bringing down its what you call liquidity coverage ratio. But that money was more to provide for the investments it has made in alternate investments, alternate investment funds, AIFs, according to the new rule. So there's no spare cash left. The third worry is that the bank's LDR, loan to deposit ratio, is a very uncomfortable 110%, which means it has given 110 rupees of loans for 100 rupees of deposits. So now it has to keep borrowing that balance 10 rupees from the market at higher rates. It's borrowing short to lend long, and that is worrying the market. It puts pressure on margins because you're desperate to borrow. And the point is that when a leader like HDFC is borrowing, at any cost, then it pushes up the cost of deposits for the entire banking system. Now, the other part is market is questioning whether HDFC Bank should get the high valuation that it has got. It is always priced more pricier than other banks. But if the margins are not going to go back to 4.3 or 4.2, but remain at 3.4, then people are questioning. For instance, ICICI Bank in the Q2 had reported a margin of 4.3%. So, people will wonder, why should HDFC Bank get a higher valuation or even the same valuation as ICICI Bank? There are some people who say, a Macquarie report says that now what do you outlook for HDFC Bank? They have to produce an operating profit before provisions of 20% higher every year, and they have to bring down their cost, what you call cost to income, by 1 percentage point. So bring down costs as well as generate profit. The other comment comes from BNP Paribas, which says that, you have to forget this 4.2, 4.3% margins. It won't get back because a large part of its product now is home loans. Home loans, by definition, are a low-margin product. And, that home loan is portfolio is what it got from HDFC. So there is a lot of negativity surrounding the bank, believing that the prices can't rise anytime soon. But what is worst is the situation, the timing. HDFC Bank is held almost 75% by foreigners. And today, the foreign community was anyway selling emerging markets in India because of a rise in the US bond yields. And therefore, the worst situation was for HDFC Bank, held more by foreigners. They are in sell mode. And there is a feeling that this is not a one-day problem or a one-quarter problem. It is likely to persist.
Right, Latha, many thanks for those details and for decoding why HDFC shares fell so much in trade today. LIC's shares